In this lecture, we are going to explore two different methods of position sizing. Position sizing is how you manage your trade's size in order to grow your equity in the most efficient way possible. There are many different types of position sizing methods, but we are going to explore two simple methodologies that tend to yield the best results and don't require complex mathematics to calculate the size of your positions. The first method is linear, and we must establish an equity threshold to change the size of our positions. For example, if we establish that our threshold will be 100%, we will only adjust the size of our positions once our equity has doubled. In other words, when it has achieved 100% return. We also need to establish an arbitrary risk level or arbitrary amount to every trade we make. Here you need to decide if you are going to use risk contraction and expansion as it was explained in the last lecture. Let's create a hypothetical example to illustrate how the linear threshold method would function. Imagine that we have an equity of $10,000. In this example, we will use risk contraction and expansion, so we will define our arbitrary risk percentage as 1%. That way, every trade we make will risk 1% of our equity regardless of our stop-loss size. Our threshold will be 100%, so when the account reaches $20,000, we will adjust the size of our trades again, but not until it hits this threshold. 1% of $10,000 is $100, so in every trade we make under the linear threshold method, we will risk $100 until we hit $20,000. Once the threshold is met, we adjust the size of our trades to 1% of the new equity, which is $20,000. From that point on, we will risk 1% of $20,000 until we reach the next threshold of 100%, which will be $40,000. The established threshold can vary, of course. The lower the threshold, the more risk you will be taking, and consequently, the faster your account will grow. However, remember that more risk can also mean larger losses, so be fully aware of that before you decide on which position sizing method you will use. Remember also that you should not use an arbitrary risk that is too high. The reason for that is that the more risk you assume, the more you will be bound to suffer from an amplified state of the cognitive biases that we will be studying in future lectures. The less risk you take, the easier it will be for you to deal with your losses and to manage your emotions in real time. The ideal scenario is for you to find the optimal arbitrary risk level in which you feel comfortable enough to open a trade when the opportunity appears, but you also don't get overwhelmed by amplified emotions. If you want to use the linear threshold method without risk contraction and expansion, you will need to determine a fixed amount to open your trades based on your available margin. That is correlated with your available account leverage, but as a rule of thumb, you should not use more than 5% of your available margin. The procedure regarding the adaptation of the trade size is similar to the example where we use risk contraction and expansion. The only difference is that without risk contraction and expansion, instead of defining an arbitrary risk percentage, you will define an arbitrary margin percentage for your trade. For example, let's imagine that you have $10,000 in an account with 1 to 200 of leverage. You also defined your arbitrary margin percentage as 3%. Since you will be using 3% of 10,000 at 200 of leverage, you will be purchasing 60,000 units, which gives you $6 per pip. Once again, these numbers are completely arbitrary because they depend on your subjective experience of risk. Just remember to not exaggerate because you want to make money fast. That's never a good idea. The other position sizing method that we will be exploring is an extrapolation of the linear threshold method, and it's called moving threshold. Consider that every time you close a position, you have a new threshold, which is the available equity in your account. This can also be viewed as risking a fixed percentage of your available equity in every trade. This is a more aggressive approach that can work for or against you depending on your performance. All you need to do is to establish an arbitrary risk percentage for your trades and make sure that all trades fit that arbitrary value, just like you learned in the risk contraction and expansion lecture. For example, let's say you have $25,000 and you want to risk 3% of your account every time you make a trade. All you need to do is use the risk contraction and expansion formula you learned in the last lecture to adjust the size of each trade. The main difference between the linear threshold and the moving threshold method is the nature of how the arbitrary threshold shifts. The method that you are going to use is completely up to you due to the subjective nature of how each person interprets risk and your tendency to be risk-seeking or risk-aversive. In the next lecture, we will be exploring the idea of shooting stops forward as a method of relieving the pressure of constant risk-taking in the market.